class of 2023. My name is Haley, and with me presenting today is Akash, Brianna, Drew, Eric, Helena, and Jose. Here's our proposed agenda for the evening, and we welcome you to participate and ask questions throughout the presentation just using the drop box or the chat box at the below, and we will answer the questions at the end as well. We will record the presentation and then turn it off for the Q&A and social at the end. So just moving into the fund's performance, the fund returned 7.37% over the quarter, which was 53 basis points below the blended benchmark. Our underperformance can be attributed to the healthcare, energy, and industrial sectors, however, was offset by outperformance in the materials and consumer discretionary sectors. Our fund currently has a 40-60 Canadian US equity exposure, which we are comfortable with. And over the quarter, the fund was active in numerous trades to align with the portfolio mandate and outlook. This included our transaction where we swapped our current position in Suncor Energy for Canadian Natural Resources at a 1 conviction. We also initiated positions in American Tower, Lynn PLC, Lululemon Athletica, and PayPal Holdings. We then divested our position in Dollarama and Knight Therapeutics and trimmed TD Bank, as well as increased our allocation to JP Morgan Chase & Co. So with this in mind, when we evaluate our current and future holdings, we always check with our CPMT mandate and investment philosophy, which includes a growing free cash flow, so allowing companies to pursue opportunities that enhance shareholder value, strong balance sheets, so maintaining intelligent capital to fund core operations, and appropriate capital structure to maximize return on capital employed, as well as income generating assets. Competitive advantages, so demonstrating clear competencies next to competitors, as well as quality management to assess the control, compensation, ESG, and diversity inclusion. In terms of benchmarks, the fund achieved its goal of absolute returns of 7% on a 1, 3, and 5-year basis, relative returns on a 1-year and 3-year basis, and risk-adjusted returns on a 1 and 3-year basis as well. I will now pass it on to Jose to discuss portfolio analysis.
Thank you, Haley. Looking at the individual performance of some of our names, the top contributors to our performance were Aritzia, Canadian Natural Resources, JP Morgan, Ross Stores, and Intuitive Surgical. The worst performance throughout the quarter were Canadian Natural Railway, American Tower, Waste Connections, and Amgen. The CPMT remains confident being overweight in the consumer staples, consumer discretionary, healthcare, and industrial sectors. Over the quarter, as previously mentioned by Haley, we entered into a position in PayPal, which has gotten us overweight in the IT sector. We're highly comfortable being overweight in the sector, given sector tailwinds and our particular high free cash flow generation capacity names that we hold within the sector. And moving on to the next slide to talk a little bit about our attribution effect. Over the quarter, the fund saw a negative selection effect, which could be primarily attributed to the healthcare, energy, and industrial sectors. This was partially offset by a large positive selection effect in the consumer discretionary sector. The fund saw a slightly positive allocation effect. The communication services and material sectors were the biggest positive contributors to this, but were weighed down by negative allocation effects in the financial and consumer staple sectors. Our selection and allocation effects resulted in net attribution of negative 53 basis points, constituting our alpha for the quarter, sadly negative. And the CPMT has also achieved a higher Sharpe ratio than the blended benchmark for the past 3 years. However, it had a lower Sharpe ratio for the 5 and 10-year trailing period. Now I will pass it on to Akash to talk a little bit about Activision Blizzard.
Thanks, Jose. So due to our underweighting in the communications sector, I wanted to explore a name that would provide exposure to the interactive entertainment industry, which has seen tremendous growth over the last 5 years, especially during the pandemic, leading to my analysis of Activision Blizzard. Activision is an American video game publisher that produces, develops, and distributes content across the globe. It operates within 3 main segments, being Activision Publishing, Blizzard Entertainment, and King Digital Entertainment, where it provides consumers with content from AAA-rated franchises such as Call of Duty and World of Warcraft. Activision also owns and operates a substantial esports portfolio consisting of the Call of Duty League and the Overwatch League, which were 2 of the first esports leagues created in the space. As well, it recently acquired Major League Gaming, adding to its competitive gaming capabilities. On the top right there, we can see the company has outperformed our blended benchmark over the last 5 years, especially during the pandemic, experiencing a boost in monthly active users due to stay-at-home orders. On the bottom right, we can see a small breakdown of Activision's revenue over time, highlighting how it's been able to consistently generate revenue split between full product sales and in-game revenues. On to the global video game industry. It has become increasingly popular over the last 5 years, growing at a CAGR of 10%. As shown on the top right, the industry is expected to see a 9% CAGR growth over the next 5 years. Advancements in technology, primarily faster internet speeds and lower broadband costs, have provided tailwinds for the space, leading to more accessible content and user-based growth, as shown in the bottom left. Additionally, publishers within the space have begun to shift away from the seasonal product business model to more of a software as a service model that allows users to play games for free, but gives them the optionality to access additional content through subscription-based services or one-time purchases, resulting in more smooth and stable revenue streams. Moving forward, an increased focus on digital distribution will be a key theme for the space as next-generation consoles continue to roll out, providing easier access to games and contents for consumers, but also the possibility for margin expansion for these publishers as they can eliminate the use of retail stores and deliver their games directly to consumers. Lastly, esports has become a rising phenomenon over the last decade and has begun to generate a large following similar to many professional sports leagues. The industry is expected to grow to around $1.6 billion by 2023, and expansions of esports across various franchises should lead to an immense amount of global exposure, in which publishers are hoping translates into higher demand for their product offerings. On to the competitive landscape of the industry, the major differentiator between the publishers is the quality of content they can offer consumers. Across the franchises listed on the top left, Call of Duty and World of Warcraft have consistently been atop the best-selling games on both console and PC platforms, while other games such as Take-Two's GTA and Red Dead Redemption franchises have fared well due to their consistent content releases, leading to a longer product lifecycle. However, these franchises are not mutually exclusive, as many consumers most likely have content from all four publishers in their libraries. Therefore, firms are basically mainly competing on providing the most engaging and compelling interactive experience for their users, and this is done mainly by releasing new content and games frequently. As for the revenue distribution on the top right there, we can see that Activision is pretty evenly weighted across its console, PC, and mobile sales, as many of its core franchises have been market leaders in those respective spaces. Over the last few years, we've also seen tremendous growth in the mobile gaming segment, and Activision has been able to do a phenomenal job of converting many of its AAA-rated titles, such as Call of Duty, to mobile-friendly versions, allowing for continuous play on the go. On the bottom left and bottom right, we have profitability metrics and valuation charts. As you can see, Activision is a leader across all profitability metrics, again showcasing the resilience of its product offerings and franchises. And on the bottom right there, we can see on a valuation basis, it trades just in line with one of its competitors, EA, but slightly below Take-Two. It has seen some contraction since the pandemic started in March 2020, but we do believe that it has room for multiple expansion, propelled by its project pipeline, which I'll touch on a little later. On to the portfolio fit, Activision has a best-in-class balance sheet with a large cash balance and negative debt metrics. It has strong liquidity metrics and also maintains a high investment-grade credit rating. The management team has been prudent in streamlining investments into its core franchises, allowing the company to release engaging and quality content year in and year out that has been viewed positively by the public. The same team also successfully integrated 3 businesses of the last decade, bringing in Blizzard, King, and MLG, allowing it to penetrate the PC, mobile, and esports industries. It has also been able to return capital to shareholders consistently through its annual dividend, and recently announced a share repurchase program that will see $8 billion returned to shareholders by 2023. Cash flows have remained steady over the last few years and saw a major uplift in 2016 as a result of the King acquisition. Additional focuses on recurring revenue and further content releases should provide a tailwind for free cash flows moving forward, as will the continuous shift to digital distribution, which may see EBIT margins expand by approximately 800 basis points in the next few years as it becomes widely adopted by consumers. Finally, Activision's main competitive advantage comes from its product offerings and AAA-rated franchises, which have been atop the charts for the last few decades and are still seeing consistent growth to date via new content releases and annual game drops. Additionally, its esports operations are among the largest in the world, and its acquisition of MLG further positions it as a market leader within a growing space. On to a recommendation on the name, we believe that Activision boasts best-in-class intellectual property headlined by AAA-rated franchises, which not only give it the ability to penetrate various video game platforms over time, but are also structured in a way that allow the company to capitalize on the shift to recurring revenue while still providing an engaging experience for its consumers. The company has one of the largest content pipelines among its peers, consisting of new content and full game releases through 2023, which we believe will further boost monthly active users and overall engagement. Lastly, the company remains a leader in the esports industry and will continue to entrench itself in this space as both the Call of Duty and Overwatch leagues expand to new cities and geographies. As shown on the bottom left here, and like I touched on earlier in the presentation, we are currently 5% underweight the communication services sector, and we believe the addition of a premier media name will further add value to our fund while providing exposure to the fast-growing interactive entertainment industry. Pending further due diligence this month, we recommend adding Activision to our portfolio at a conviction of 1 with an implied return of 24%. I'll now pass on Eric to talk about Ericsson.
Thanks, Akash. Over the quarter, Sector wanted to have a look at a new telecom name, so after it was screened for his IA pitch, Kian and I had a look at Ericsson. Starting with a business overview, Ericsson, or ERIC, is an integrated telecommunications technology and services company based in Sweden and listed on the NASDAQ. They provide network infrastructure for mobile and fixed communications on a global scale. The company holds the world's leading patent portfolio in cellular technology with more than 54,000 granted patents and over 100 signed licensing agreements. Ericsson was the first company to enable 5G services in 4 continents and supports over 2.5 billion subscribers across its cellular networks globally. The chart in the bottom left shows the global market of radio access networks, or RANs. Ericsson maintains a slight majority of the market share at just over 32%, with Huawei in a close second at 31%. So Ericsson is a massive global player in the telecom space. Looking at their debt in the chart in the bottom right, Eric's total debt to EBITDA multiple has been relatively sporadic over the last few years, most notably due to a few quarters with negative EBITDA, which explains the gaps in the charts. But after this period, we see a steady decline after Q2 of 2018, which can be attributed to some new management put in place, which I will go into further detail later in the presentation. Looking at how Ericsson's financials fit with the CPMT mandate, in the top left, we have some information on the company's research and development. Keep in mind, these figures are reported in Ericsson's domestic currency, which is the Swedish krona. Just for a benchmark, currently $1 exchanges to roughly 8.5 krona. ERIC has committed a healthy and stable portion of its top line towards researching new products and has been increasing it slightly in the last few years. Also in the top right, its free cash flow has improved substantially since 2017. Notably, from the period between 2015 and 2019, the company's levered and unlevered free cash flows grew by CAGRs of 24 and 23% respectively. Despite this growth, ERIC has seen fluctuations in EBIT with a CAGR of negative 6.3%. Now looking at its balance sheet, as of Q3 2020, ERIC exhibits assets to equity ratio of 3.35 times relative to its 2016 value of 2.11 times. As well, it's been able to steadily increase its cash position, as shown in the bottom left. When considering its valuation against its peer group, we had to look before and after its period between late 2016 and early 2019 in order to compare it fairly. When compared to its appropriate peer group, specifically the companies CommScope, Cisco, and Nokia, Ericsson trades very much in line with its peers. Now moving on to the next slide. Looking at Ericsson's management, it has gained a lot of new faces in the last 4 years. Most of its senior management was replaced in 2017 by the board following poor financial performance. This new management is in large part composed of people that have been with the company for a long time and have excelled in their respective business groups. As well, Ericsson's board has a handful of newly elected members, but the large majority of them have a decade of industry experience, Bourrier being a member since 2006. Ericsson's management was one of the things we paid close attention to when looking at Ericsson. Despite displaying competency, its management team continues to be hindered by the previous management team's actions, including the US $1.1 billion fine the company was given in 2019 by the US Department of Justice as a result of violations of the Foreign Corrupt Practices Act between 2000 and 2016. Other key risks include our exposure to the krona and all other currencies in the countries that ERIC operates in. As well, there's a considerable risk with Ericsson being able to execute its growth strategy to meet the growing 5G demands, as we see this as one of the few areas ERIC can observe growth in for the near term. All things considered, we valued the company using a 5-year DCF with a WACC of 5.88%. We modeled it using a 50-50 blend of the Gordon growth method with a terminal growth rate of 2% and an EV/EBITDA exit multiple of 9.1 times, arriving at a price target of 97 Swedish krona. This corresponds to a final price target of US $12 with its dividend of just under 2%. In summary, so while Ericsson did pass a screening of its peers due to its ability to secure contracts in the Canadian market, and again through our IA pitches in the fall, after a more in-depth analysis, it did not meet the core pillars of our investment mandate. As a global leading license leader of 5G technologies, Ericsson has the potential to capture significant market share in the segment, but it needs to earn the trust of its investors back before warranting a re-rating. The company's positioning in the space and outlook make it an attractive company to monitor going forward, so we will continue to monitor the name. If Ericsson can continue to demonstrate improving financial and operational health, then we will revalue the company and reassess it as a suitable investment for our portfolio. I will now hand it off to Brianna to talk about Lululemon.
Awesome, thanks, Eric. So the consumers team looked into Lululemon Athletica, or Lulu, over the quarter, as it has been on my radar all the way back to when I actually pitched it for my CPMT interview about 2 years ago. So moving into the next slide, Lulu is a Canadian-born activewear apparel company that designs, distributes, and retails internationally. Lulu was founded in Vancouver, BC by Dennis or Chip Wilson in 1998 and opened its first standalone store in Kitsilano in 2000. So you can see on the top right that Lulu has obviously outperformed the blended benchmark by quite a substantial amount throughout the past 3+ years. I also wanted to show this graph on the bottom, as well as this is going to be something I touch on more in the next few slides, but it's really able to show the growth that the e-commerce platform has had, partially due to the COVID pandemic. Moving to the next slide. Stores began in Canada and the US, and then they branched into places like Australia and China. So currently the APAC and the EMEA regions are a large focus for Lulu. And we can see in the top right, the growth over the past 9 years of the amount of countries that the company has been able to expand to has been quite notable. And you can also see the amount of revenues that international sales are bringing has been increasing fairly stably as well. So moving to the bottom section and kind of more towards mandate fit, Lulu has had an impressive ROIC over the past few years, and its annual free cash flow has been quite strong with a 22.2% CAGR over the period shown here. So some of the competitive advantages that Lulu offers is its intensive brand recognition and the following behind the name that is quite unprecedented. Another fact is that the company lacks any true pure play peers in relation to its product offerings and the overall brand. The company currently has no debt nor pulled anything from its revolver, which is quite impressive considering the COVID pandemic. And just some liquidity metrics, its last 12-month current ratio is fairly in line with industry at around 2.2 times, and it has a fairly healthy cash balance. Another draw that we really liked that I couldn't fit into slides here was Lulu's extensive commitment to ESG through initiatives like implementing a head of global diversity, equity, and inclusion role, offering more inclusive sizing ranges, and ensuring all products include sustainable materials by 2030. Moving into the next slide, Lulu's current strategy is called the Power of Three Growth Strategy, which focuses on product innovation, omni-guest experience, and market expansion. So with things like more inclusive sizing, a strong e-commerce platform, focusing on international expansion, and its recent acquisition of Mirror, which is similar to Peloton as a home workout option, the company has already been able to realize strengths in this strategy. Lulu's e-commerce platform was launched in Q1 of 2009, and they began reporting growth metrics the following year. And so you can see in the top right-hand corner, the growth it has seen as a percentage of net revenue has been quite impressive. And just a note that last 2019 number wouldn't include the impact of COVID, as that's their Q4 end, which is just right before COVID hit. Then moving on to the bottom of this slide, another competitive advantage showcased here is in these comparisons. So we can see Lulu with a very strong last 12 months ROIC in comparison to peers, and the only company that's been able to realize revenue growth year over year in the last 12 months. Moving to the next slide, COVID was, of course, a big impact for Lulu as it has most of its stores in malls. And so given closures to many of the company's stores, e-commerce is really what kept it afloat. All of the senior leadership team reduced their salaries by 20% for 3 months, and everyone on the board forwent their cash retainer. And employees were all also paid all the way to June 1st, even if stores weren't open. We can see the graph on the right with the revenue growth over the last 3 quarters and how COVID has really impacted some of the major players in the space. And I wanted to show in the bottom left, this is the amount of stores opened by Q3 in the past. So we can see that as of right now, Lulu is trending to be fairly in line with that. And just a note, in my model, I did estimate around 30 stores to be open this year. So we're on track to kind of hit that. And then lastly on this slide, I just wanted to show SG&A expense as a percentage of net revenue to see that it's trending back to more pre-COVID levels. So finally, on the next slide, we get to the investment thesis and recommendation. The CPMT entered into a position in Lulu on November 24th out of one conviction. And we decided on this one conviction to kind of dip our toe in and keep monitoring the position given any more kind of COVID impacts or COVID news. So as I've already discussed, I believe that Lulu checks off all the mandate points. I know it is trading at a premium, but I feel that this premium is clearly warranted. And so when I pitched the name on a PE basis, Lulu was fairly higher than peers, but on an EV to EBITDA basis, it was only about 5 times higher than Nike. When you look at Lulu on a comparison basis as well, and nearly every other factor, as I've shown here, Lulu is clearly best in class. When I modeled the company, I used a 50-50 blended Gordon growth and EV EBITDA exit multiple. And I used a multiple much lower than industry average as well to work in a more conservative growth runway in a sense for Lulu. I wanted to include this last graph here to really show that the sportswear apparel part of the apparel market has seen quite strong growth throughout the past few years, and research is planning or is forecasting that to continue. To leave you with some final thoughts, we view Lulu as an impressive growth story up until now that is showing no signs of stopping anytime soon, which was a huge reason for our decision to enter into a position. I'll pass it off to Haley now to talk about North American healthcare.
Thank you, Brianna. In 2020, the healthcare sector had undergone rapid innovation, consolidation, and pressure due to the COVID-19 pandemic. CPMT invests in Amgen, Abbott Laboratories, and Intuitive Surgical, and realized negative selection effect due to more company-specific reasons rather than solely systematic. The fund is diversified across biotech, pharma, and medical devices healthcare industries. So over the quarter, Stephen and I wanted to gain a further insight into the broader healthcare performance and responses to explain the healthcare performance within the portfolio. Moving into the biotechnology industry, it develops novel drugs aimed at treating unmet medical needs and tends to have higher levels of risk in R&D, whereas pharmaceutical companies are more established and diversified with successful drugs in the market and various development stages, along with long-term research projects, and is more sales and marketing focused. So despite pandemic headwinds, the NBI outperformed the S&P by roughly 28%, and the healthcare sector is expected to contribute 17% of the S&P's growth in 2021, with 8% of that being accounted for by the biotech industry. This can be attributed by the biotech sector's ability to administer later stage pipeline commercial drugs to satisfy the current high demand for medical treatments. In addition, biotech companies Moderna and Pfizer and Biotech have began distributing COVID-19 vaccines. And in addition, 53 new drugs were also approved year-to-date 2020, which is roughly in line with 2019 and 2018 levels amidst delays and restrictions. So on the top right and bottom left charts, we can see that the healthcare industry had strong performance over the year, with the strongest being the biotech next to medical devices and pharma. So moving into medical devices, they develop medical and surgical instruments for physicians to diagnose, treat, and prevent medical conditions. These instruments include electromedical and electrotherapeutic apparatuses, such as the ultrasound and MRI equipment or surgical robots. Although the pandemic created significant demand for respiratory ventilators and respirators, growth had been overshadowed by temporary pauses to non-emergent and elective procedures. So the US healthcare institutions experienced roughly 200 billion in financial losses between March and June of 2020. And in total, the medical device industry saw a decline in revenue of 5.7%. However, Abbott Laboratories, Edward Life Sciences Corporate, and Intuitive Surgical were among the top companies in the year-over-year stock price performers due to having operations in high growth segments such as diabetes. Global expenditure on diabetes is expected to reach roughly 490 billion by 2030, and the diabetes devices market is expected to grow at roughly 7.8% CAGR, which the fund has exposure to by Abbott servicing that market. In addition, US elective procedures at the end of 2020 were estimated to be at roughly 80 to 85% of pre-pandemic levels, and is expected to increase to roughly 90 to 95% in 2021. So this industry's key catalysts include the number of physician visits being correlated with purchasing and replacing or licensing medical equipment, advancements in medical treatment that increases life expectancy, favorable legislation in which they operate, and select industry segments as key growth drivers for device companies, such as diabetes, as I mentioned, robotic surgery, and transcatheter aortic valve replacement. So just moving into the North American healthcare on the following slides, key themes to monitor in 2021 include the COVID-19 vaccine innovation, distribution, and effect. So herd immunity and vaccine rollout are key catalysts for returning to greater normalcy in R&D, sales and marketing, and product life cycle operations. So as you can see on the top right, kind of just efficacy levels with the current vaccines. In addition, the healthcare reform in the US is another catalyst for the industry as it attempts to address the high list prices for prescription drugs rising out of pocket costs and currently limited access to affordable options with the breakdown in the pie chart below. President Joe Biden's plans to allow Medicare to negotiate with drug manufacturers would secure lower prices in this instance and establish a review board for competitive price setting and allow that or enable that drug advertising no longer be tax deductible. Innovation is another key driver for this sector and expected in 2021 launches in the near term are from Bristol Myers, Johnson & Johnson, Amgen, and BioMarin. Additionally, investment in the digital tools and data analytics will also improve patient experience, retention, and clinical trials and shorten the release time to market. And Endeavor RX, for instance, is one of the first and only prescription treatments to service the ADHD market through a video game. And then favorable regulatory environments are also key to the healthcare sector overall, and FDA has been quite active in its approvals. The FDA granted roughly 151 fast track designations in 2019, which was up 115 year over year. And lastly, M&A activity. There were 12 public US M&A deals announced versus 2017 in 2019, and the bulk of this activity was driven by larger size acquisitions. Notable acquisitions of this size included Bristol Myers' $13 billion acquisition of Myocardia and Johnson & Johnson's $6.5 billion acquisition of Momenta Pharmaceuticals. And notably, Amgen, one of our holdings, also recently announced its acquisition of 5 Prime Therapeutics for $1.9 billion in cash. I will now pass it on to Helena to discuss PayPal.
Thank you, Haley. So this evening, I will be discussing PayPal. And PayPal is a name that has been on our radar since the summer. And following due diligence conducted on the name by myself and Katie over the fall, the fund recently added PayPal to the portfolio in November of 2020. PayPal is a leading digital payment solution platform that was incorporated in 2015 after being spun off from eBay. It operates a global two-sided network between consumers and merchants, providing a one-stop payment solution. The company earns its revenue from a variety of fees, which are associated with its 348 million consumer accounts and 29 million merchant accounts. As you can see on the bottom left-hand side of the slide, about half of PayPal's revenue currently comes from the US. However, because PayPal's business model is extremely scalable, the company's total addressable market is massive and extends globally. This means there is significant room for market penetration in other countries, providing a strong runway for growth. In the next couple of years, PayPal is targeting markets like Japan, Brazil, and Mexico. As you can see on the bottom right-hand side of this slide, over 90% of PayPal's revenue is directly related to its transaction payment volume. Revenue has grown consistently at an 18% CAGR since 2013. Next, taking a look at PayPal's brand portfolio. As you can see on the left-hand portion of the slide, PayPal's core proprietary payments platform consists of PayPal, PayPal Credit, Braintree, Venmo, among others. And these platforms all facilitate electronic and mobile payments, digital wallets, credit and debit solutions, as well as money transfers. Inorganic growth is also a very key element of PayPal's strategy. And as you can see on the right-hand side of the slide, which shows a number of their acquired brands, most recently, PayPal has acquired Honey for $4 billion in January 2020, and it acquired a controlling interest in GoPay in December of 2019. And this GoPay transaction allowed PayPal to become the first foreign payment platform to provide online payment services in China. Next, to give a quick overview of the industry, the payments and processing industry facilitates money movement between consumers, merchants, financial institutions, and governments. As you can see on the bottom left-hand portion of the slide, dominant players include the credit card companies such as Visa and MasterCard, with PayPal holding a large 14% market share as of Q3 2020. As shown on the right-hand side of the slide, the COVID pandemic has actually served as a tailwind for the payment space in many ways, specifically due to the increased adoption of e-commerce. However, we view the pandemic as an accelerant to what has been an existing secular shift in consumer and merchant behavior. As you can see in the chart on the right there, cash payments have decreased significantly in mature markets over the last decade, and consumer behavior has also shifted to reflect a greater comfort in and preference for online shopping and point of sale credit options. Next, taking a look at PayPal internally, the company's business model allows for very low capital intensity. On the next slide, which shows significant free cash flow generation since the company's incorporation, representing a CAGR of 25%. As you can see in the top right of this slide, PayPal allocates its excess free cash flow to both strategic acquisitions as well as share buybacks. PayPal has an extremely healthy balance sheet as well, which is in a net cash position with 13 billion of cash compared to total debt of 9 billion. And we view PayPal's underlevered balance sheet as critical in providing the company with the capital allocation flexibility it needs to pursue both organic as well as inorganic growth. And lastly, for this slide, on the bottom right, although PayPal trades at quite high multiples on an EV to EBITDA basis, it has historically tended to move relatively in line with its credit card peers, especially MasterCard. And finally, moving into our investment recommendation for the name. As you can see in the two charts on the top of the slide here, starting with the one on the left, total payment volume, PayPal has seen extremely consistent growth in its total payment volume, and this is arguably the strongest driver of value for the company. Underlying this top line metric, PayPal has grown its number of active accounts, the rate at which net new active accounts are added, and the number of transactions per active account, which all contribute to this total payment volume number, which PayPal is aiming to triple over the next 5 years. Overall, we view PayPal as a growth story that is able to take advantage of this secular shift in consumer and merchant behavior towards digital and mobile payments. PayPal has an extremely high level of brand recognition and global cross-border capabilities, which we believe, coupled with its extensive total addressable market, will allow the company to capture increased market share moving forward. As a result of this analysis, the fund entered a position in PayPal on November 30th. To date, our holding period return has been 12%, and our recently updated target price is $308. I will now pass it off to Jose to discuss Prologis.
Thank you, Helena. For a while now, we have wanted to take a look into the industrial real estate market, given the structural tailwind supported by widespread adoption of e-commerce. So I took a look at Prologis to see if it would be a fitting addition to the real estate portfolio. Moving on to the next slide. Prologis is the global leader in the logistics real estate market with presence in 19 countries over 4 continents. The company divides its operations into the real estate operations segment and the strategic capital segment. The real estate operations segment engages in leasing activities of logistics real estate, which composes 85% of total revenue and funds from operations, or FFO, in any given year. The strategic capital segment, on the other hand, engages in the management, co-investment, and acquisition of real estate assets on behalf of partners who then pay PLD a fee for its services. The company makes portfolio decisions based on the aggregated value of all assets it manages, as you can see on the bottom left. This owned managed portfolio is composed of the company's owned and operated assets, as well as the assets it manages on behalf of clients and co-investors. The gross book value of the portfolio is $85.3 billion, and PLD owns a $44 billion portion, which is 95% concentrated in the US. Additionally, from the graph on the bottom right, you can see that the company has been able to consistently grow its FFO and adjusted FFO, or FFO, while growing its FFO margin over time, alluding to its stable cash generating capacity. Moving on to the next slide for a quick overview of the industrial real estate market. As you can see from the graph on the top left, e-commerce has been a very steady trend even before it became a necessity during the pandemic. US e-commerce penetration, which is the number of online sales as a percentage of total retail sales, has doubled in the past 7 years. US e-commerce sales have had a 7-year CAGR of 13.65%, while globally the 7-year e-commerce sales CAGR has been 17.8%. In regard to industrial real estate market fundamentals, the US has seen yearly absorption grow from 149 million square feet, or MSF, in 2011 to 240 MSF in 2019, with vacancy rates declining from near 10% to around 4.5% in the same time period. Europe saw an increase in absorption of 50 MSF in 2010 to 130 MSF in 2019, with similar vacancy rate declines. On the other hand, Asian markets have followed a different trend in the same time period. Vacancy rates in the region have continuously hovered around 10% since completions have consistently outpaced absorption, creating oversupply. We do note that although European and US markets have stayed resilient, completions seem to be overtaking net absorptions, which could hint at oversupply, a concerning fact given a historically low cap rate environment within this real estate subsector. In the top right table, I wanted to compare PLD to its subsector peers. And as you can see, PLD stacks up well from a credit and valuation standpoint. The company's price to FFO ratio is well in line with peers. And additionally, PLD can cover its interest payments much better than peers, and it does seem to be more levered than the peer average in net debt to EBITDA terms. But as you can see, its best-in-class credit rating supports these debt levels. Moving on to the next slide to mandate fit. We first take a look at the healthy balance sheet mandate point on the top left. As you can see, PLD has been able to lower its total debt to EBITDA ratio over time from nearly 10 times to 5.6 times by the end of 2020. As well as observed in the comps table, the company also had the highest credit rating within its peer group, as well as best-in-class interest coverage ratio. Now moving on to the competitive advantage mandate point. First, being the biggest player in the industrial real estate space, the company has a vast network of connected assets and established clients. The company has over 55 clients across the world, and its top 10 client list includes Amazon, Walmart, UPS, FedEx, Home Depot, PepsiCo, and the US government, which are expected to continue to show robust demand for PLD's facilities in the long run. Second, the company has showcased its ability to source and execute on accretive deals by continuously increasing its FFO and AFFO levels, which are real estate proxy metrics for cash flow from operations and free cash flow, while also increasing its FFO margins. And third, the company is widely recognized as a corporate ESG leader. The Dow Jones Sustainability Index recognized PLD as the top 10 global REIT for its ESG efforts. MSCI gives PLD a AA rating, placing it amongst the top 27% of real estate companies in this regard. And lastly, due to its scale and reach, PLD has its own real estate research center, which allows it to continuously update its view on the market and make informed capital allocation decisions before competitors purchase this research. Moving on to valuation on the bottom left, the company has consistently traded above peers on a price to FFO basis, but always within an acceptable range. The industry overall has seen a significant increase in valuations, but this had been a trend even before the pandemic. In regard to quality management and shareholder focus, as showcased by the bottom right graph, you can see that the company has consistently focused on shareholder returns by routinely increasing its dividends while lowering its FFO payout ratio over time, allowing it to compensate shareholders while still investing money back into its core business. Now, moving on to the next and final slide. Ultimately, we decided the best course of action for the time being was to stay on the sidelines with this trade. The CPMT does recognize that PLD is a well-managed company that does fit our mandate. However, we're concerned about some external factors such as the following. First being US Treasury yields and ECB rates have continued to spike, reaching their highest levels in a year. When asked about this in his most recent public address, Fed Chairman Jerome Powell did not signal any imminent plans to address this rise in yields, which drove rates even higher. This is concerning for PLD as 65% of its debt is either euro or dollar denominated. Additionally, we believe rising rates would weigh on revaluations overall. So in case of a market rally and more value-focused names, as we have been seeing, this would not be the best place to allocate capital. Second, we have consistently had positive allocation effects in the real estate sector, while being underweight. So we believe that it is prudent to maintain our position instead of increasing it for the time being. And lastly, we earlier mentioned that industrial real estate fundamentals were signaling an oversupply within the sector. We're also concerned that in a recent investor call, PLD's CFO did acknowledge that compressed cap rates did create a challenging capital deployment environment. So for these reasons, we choose a no action recommendation on the stock for now, but we'll keep the name in our radar as the IA class transitions into their PM roles over the next quarter. Now I'll pass it on to Drew to discuss TELUS.
Thank you, Jose. TELUS has been a long-term CPMT holding, and we wanted to take a deeper dive within the telecom sector. So therefore, Sina and I looked into TELUS for this quarterly. So TELUS Corporation is a telecommunications company offering wireless data, internet protocol, voice, television, entertainment, video, as well as security services to around 16 million customers globally. TELUS Health is Canada's leader in digital health technology, improving access to health and wellness services, and revolutionizing the flow of health information across the continuum of care. TELUS Agriculture provides innovative digital solutions throughout the agricultural value chain, supporting better food outcomes and improved agribusiness data insights and processes. TELUS International is a leading digital customer experience innovator that delivers next generation AI and content management solutions for global brands across technology, games, e-commerce, fintech, communications, media, healthcare, as well as the hospitality sectors. TELUS and TELUS International operate in over 25 countries around the world, and the company reports its revenues under two segments, namely wireless and wireline.
The wireline segment consists of data services such as voice, television, security, and cloud-based services, while the wireless segment encompasses fees generated from roaming, data overages, and IoT solutions, among mobile technologies. On the top right, we can see TELUS's trading performance versus the blended benchmark, and on the bottom left, we can see the revenue breakdown for quarter 3, 2020. Finally, the bottom right shows TELUS's wireless and wireline EBITDA margins over the past few quarters. Going to the next slide. Thank you. Quickly going over 5G. Over the next decade, the Canadian telecommunications sector is expected to experience a fundamental change with advances in 5G technology. National operators such as TELUS, who have established a network of business relations, are expected to secure more business IoT contracts than regional operators. TELUS's 5G network expansion across Canada remains on schedule and is estimated to create around 250,000 jobs and contribute about $40 billion annually to the Canadian economy. In terms of ESG, TELUS aims to make its operations 100% net carbon neutral by 2030 and receive 100% of its electricity from renewable energy sources by 2025. TELUS is also in the Dow Jones Sustainability Index, which tracks the performance of the world's leading ESG companies. TELUS received numerous awards for being a top company in North America for workplace health and equality, and has been involved in leading the world in social capitalism. On the bottom left, we can see TELUS's going free cash flow as well as stable net debt to EBITDA multiple over the past few years. On the bottom right, we can see TELUS leads its Canadian peers in having the highest ARPU and the lowest churn rate. Next slide. TELUS was revalued using a 5-year DCF model, and we arrived at a target price of $28. The CPMT expects TELUS to have strong wireless subscriber growth, low churn rates, higher ARPUs, and stable margins in the upcoming years. While the overall telecommunications sector has been stable, it has not had attractive historical returns. Since entering into the position, TELUS has significantly underperformed the relative to the fund's blended benchmark. The CPMT sees TELUS as a strong operator. However, growing competition in the wireless segment from Rogers and Bell could pressure its market positioning. That being said, on the top right, we can see that TELUS has outperformed its Canadian peers over the past few years. In conclusion, TELUS fits the mandate, and the CPMT sees it fairly valued, and TELUS does not provide the significant upside compared to a company like Activision within the sector. However, TELUS does have the best growth outlook among Canadian peers, which justifies the premium multiple, and with TELUS Healthcare and TELUS Agriculture being the next growth catalysts. The CPMT will continue to seek and analyze other names in the sector that provide desirable exposure and returns, but we're comfortable holding TELUS. With that, I will now pass it off to Akash to discuss quarter in review.
Thanks, Drew. So over the last few months, the CPMT has been quite busy, beginning in January 2021 with the fund hosting its annual Barrier Lake recruiting event. Due to the pandemic, we were forced to shift our usual activities to a virtual format, which included 2 presentations from CPMT alumni and current board members Jessica Halsman and James Anderson, who spoke with prospective students about their careers and experiences within the fund. We'd like to thank both Jessica and James for their continuous involvement with the fund's recruiting activities every year, as well as the many industry professionals and alumni that are involved throughout the entire process. We also ran an interactive case study about one of our portfolio holdings that Drew just spoke about, TELUS. Through this, prospective students were able to get an insight into the type of work and analysis that CPMT members do. In February, we concluded our recruiting cycle for the class of 2023, welcoming 8 bright new investment analysts into the fund. Adriana Delata, Arnav Mayank, Emily Chen, Eric Zhao, Gavin Stallwick, Carlin Slater, Nurazim, and Wesley Sherrard, who are with us here tonight. Additionally, the fund also trimmed our position in Aritzia slightly to help fund our annual distribution. Lastly, over the last few months, the fund has been very engaged in speaker series from alumni from across the globe, and we would like to thank the firm shown below for taking the time to provide the fund's members with invaluable insights about their careers and the overall industry. During the last year, the fund has been continued to produce high-quality content via its quarterly presentations and reports, while continuing to create value for its members within the fund, all within a virtual environment. That being said, we would like to thank everyone for attending our Q3 presentation, and we will now field any questions.
First of all, I would like to say that I thoroughly enjoyed the presentation. I thought that each and every one of you did a phenomenal job. Haley, at the beginning of the presentation, you mentioned that the portfolio has a 60-40 Canadian equity